Welcome to the Horizon videozine. Well, it's the month of May, and the most important question on everybody's minds is which way is the market headed? Today, we have got some strategies for you which can be implemented in the May series, and we look upon some of the challenges and key areas which the market needs to tackle. Now, coming to the historical setup, now May has been a positive month historically. If you look at the last decade, 7 out of 10 instances, Nifty has given a positive return in the month of May, and the average positive return has been plus 2.4%. Now, to add to this, India VIX hit a record low of below 10.5% just few days back. Now, whenever India VIX has gone below the 10.5% mark, the 1 month return, the following 1 month return in the Nifty has been mixed. So last 17 years of history was tracked by our Insta team, and what the outcome came was, of the 4 instances that India VIX dipped below this mark, 2 times the return of the index was negative, once it was positive, and once it was neutral. Now when the return was positive, the return was in the vicinity of 1.5%. When the return was negative, it was minus 4.1%. So one thing is for sure, if the market does come out of this broad consolidation that we are in, expect a trending move that can emerge in the month of May. Now let's look at the technicals flavor of the market, how the setup is. Now, as you can see in this graph, Nifty is in a rising channel. We did break this rising channel momentarily in the last month when the news broke out of the Iran-Israel crisis. Post that, Nifty has sort of honored this range. On a closing basis, we have not gone below the green line as we can see in the graph. And at the same time, the 50-day exponential moving average has turned out to be a pivotal level, pivotal average in this entire period. Now, what is definitely happening is the momentum at which the Nifty is moving is going down. So on the RSI, you can see a descending asymmetrical triangle which is on the verge of a breakdown. If that happens, that should be another negative signal on the Nifty. At the same time, if the channel breakdown happens, we can expect a kind of a 4% down move in the Nifty, which history has seen in the past. Now, speaking of levels, we closed the month of April around the 22,600 mark. If we take out around 4% from there, we are coming close to around the 21,700 area. So this is what the expected downside is in case the markets reverse and start going up. So around 2% would put us very close to the 23,000 mark on the upside, and in case that happens, that should bode well for the new month, which is June, which is post the event as well. Now, the key levels to keep an eye on. The first key level is the 50-day exponential moving average. 22,230 is the average as we speak. That should bring in some support for the Nifty in case that level gets tested. Then we have a floor support at 22,000 on the downside. This level was honored even in the month of April, and this month also we expect good supply, a good demand to happen around this level. And lastly, a capitulation point where bulls might surrender their long positions in a big way is 21,777, which is the panic low that we hit last month. Now, the technical ceiling for the Nifty is established at 22,800. So it has been thrice on the daily charts that the Nifty has tried to cross this level, but there has been profit booking time and again which has come in, which has pulled the Nifty right back closer to the 22,500 mark. Now, the call writers are very much present at the 23,000 strike price, which again is a stiff resistance for the Nifty. And as far as the bearish candle that the Nifty formed on Friday, the bearish engulfing candle, the first alarm bell that was seen on the daily charts, that should play a pivotal role as to how we progress from these levels. Now let us look at India VIX, which should be the highlight over the next few trading sessions. In fact, India VIX has historically gone up during big events, and as we know, general elections are an event of a very big magnitude. So India VIX has already started giving green shoots. The index has closed above its 50 weak moving average. This has happened every time this has happened. Nifty has gone into an uncomfortable zone where Nifty has seen volatility, Nifty has seen corrections. And the first stock that we see is the top that we formed in the month of March is around the 16.74 mark, which is almost navigated, and above that 19.39 and 22.89. So these are the three levels on the India VIX index, one after the other. As they get breached, expect Nifty to witness more and more correction and volatility at the same time. Now, how do we position ourselves in such a scenario? What should be the strategy, actionable strategy to be adopted in this month, which can help you play on the downside? Now, there are three ways to do this. If you're looking for a passive hedge, you could simply look to buy the put options on the Nifty, the 30th May expiry put options of 22,000 strike price, indicative price of 131. This is as of Friday at the time of this recording. These put options have closed at a price of 131. You could look to buy these put options in the range of 130 to 160. And there are two advantages to this. If Nifty does start correcting and there is a breakdown that happens and Nifty does go towards the 21,800, 21,700 mark, we could very well see these put options go up, not only because of the price correction, but also because there could be an IV gain as well. So once the IVs start shooting up, that will aid in the pricing of these put options. And at the same time, whatever theta damage or decay in time value that this option might experience can be set off with a hopeful increase in the IVs going into the next few sessions. Now, another way to hedge or take a short position would be to create an active hedge by using the Nifty futures. So you could look to short Nifty futures around the 22,800 mark, which is where the resistance for the Nifty is placed, very stiff resistance, with a stop loss of 23,200. The May futures can be shorted in this area, and on the downside, it can work as a relatively stronger hedge as compared to the put option. Now, a spread can also be initiated with the same kind of view. So you could do a spread strategy by buying put options of the 22,500 strike price, indicative price of rupees 286 as of Friday's close, and sell the 21,700 put options at an indicative price of rupees 80 as of Friday's close. Both these contracts are of the 30th May expiry, and the good thing about this strategy is the risk reward is a very healthy 1:3 in this strategy. So the maximum downside is approximately 200 points if the view goes, if the market is not correct. But if the markets do correct on an expiry basis, the maximum gain stands at close to 600 points multiplied by the quantity that you do. That would be your profit in case the correction happens. Now, simply do equal number of quantities in both the legs, since this is 1:1 bear put spread, and this strategy can act as a hedge, especially if the Nifty comes down. Now, selling the put option also brings in some premium on the reduces the cost for the long put option, so that acts as a reduction in the initial cost of creating the hedge. Now, coming to how can we make a strategy? Can we have a plan of action in place, especially if the volatility is expected to go through the roof? Now, simply put, as long as India VIX is above the 50 DMA, look to avoid long aggression. So the 50 DMA at this point in time is around 13%. So every time India VIX is above 13%, avoid long aggression, especially on the derivative side. Intraday wild swings is something that in a high VIX scenario are something which will happen. So expect a lot of whipsaw movements in the index. Now, not necessarily whipsaw movements are bad. More swings is equal to more opportunities. So especially if you're a day trader, we would advise you to stick to day trading, especially in index options and index futures, because that is where the opportunity can be highest, and at the same time the risk can be relatively lower, especially if the view goes on the wrong side. Now, position sizing is something that can go a long way. So look to keep your position sizing small. If you're doing 10 lots on a regular basis, do 5 lots. If you're doing 100 lots, you could probably do 20-25 lots on the trading side. So not only on the long side, but also on the short side, the volatility can hurt you. So the bullish is, I think, something that will help you get this month over, especially when we have a big event on the cards. Now, the shopping area for the Nifty, where should you look to create long positions? We advise taking a basket approach at this point in time, group of stocks rather than selecting one or two stocks and taking concentrated bets. Instead of that, you could look to have a diversified approach. Look to create basket near the Nifty support levels. So 22,000, like I said, very strong support, and 21,800 is where the second support for the Nifty is. So look to add longs into quality stocks, quality setups at these two levels on a staggered basis, and remain hedged, especially in this month, unless we are done with the event. And like every other event we've seen in the past, this too shall pass, and we expect Nifty to climb this wall of worry. And once it's done, markets will be back to what the macro fundamentals and technicals globally are. We hope you have a profitable month of May ahead. Thank you so much, and have a good trading month ahead.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.